think that's not appropriate. Just kidding.
PG.
That would be me. I think that's not appropriate. Just kidding. See?
You closed lips.
Oh man. All right. And there we go. All right. So we are about just 1 minute, and then I'll open it up to everyone.
Okay.
Let's see. Let's see if I can find.
Do I need to hit start webinar, or once you do it, it will?
Yes, once it opens up, then cool. So we'll see if everybody will show up. Always like 50% off the registrants. I don't know why. It's very predictable. It's always 50%.
Right.
I'm gonna also share screen first. Sorry, I'm gonna go back to here. Okay, what do you see right now?
Just says you have started screen share.
Cool, perfect. Okay, that's good. There we go. All right, I'm gonna go ahead and start the webinar.
Okay.
And there you go. I'm gonna make sure I do record it, or else I'm gonna regret not recording it afterwards. Ooh, it had happened to me once.
Oh,
You should have seen how I was at the time.
I would have been crying.
I was kind of in tears. I was just like, I cannot believe I did not record it. But that was in the beginning of this whole thing. I think it was like my third or fourth episode, and luckily I had something on Facebook, so it wasn't too bad.
Yeah, it's not that bad. Yeah, I mean, to do all of that and it's not recording. Oh my God.
Exactly. All right. I see that a few people start to roll in, and I'm going to go ahead and open up my Q&A box and my chat box just in case, although it's pretty hard to monitor both places, but I will try my best to monitor them. And we are also live on YouTube right now, so in case, if somebody wants to actually ask questions on YouTube, we can also monitor that. So it does require quite a bit of multitasking here.
Okay.
All right. So I'm going to get started because I know we're going to have a lot of things to cover. And today I'm so excited that we have Mark Hicks to join us and going to be sharing with us about commercial property insurance policy, what kind of mistakes that we should avoid, and how to maximize coverage. So I cannot wait to talk to you, Mark. Thank you so much for coming on.
Thank you for having me. I'm excited.
Absolutely. Me too. I'm really excited. I know I'm going to have a lot of questions, so I'll try to make sure that I share my time with the audience as well. So let me go ahead and get started. First thing first, kind of want to share some news with everybody. Reminder with everybody first is that be sure to follow us on Facebook, Instagram, TikTok, and also LinkedIn. And of course, don't forget to subscribe on our YouTube channel. A lot of you may not know, and I never really kind of talk about it. I just kind of sharing with some of my friends on Facebook is that we actually have a Facebook page, Facebook group. It's called Bay Area Housing Market Updates and News. That's where we kind of share about like what we see, live updates on news, and also like talk about like the market condition. So besides our monthly town hall webinar, we also do kind of share a lot of news on our Facebook page. So hopefully you guys can join us on Facebook, and then we can have more conversation besides on this webinar. And also I want to kind of make an announcement. This is very special because tonight, as a matter of fact, tonight, Santa Clara County Association of Realtors is going to be recognizing the top realtors within the association. And Santa Clara County Association Realtors have about 7,000 members, close to 7,000 members. And we are very, very, very honored to be able to make to their top 1% and also top 3% for Susanna Young within the membership. It definitely has it's a lot of hard work. It's not easy to achieve, and I still kind of have to pinch myself sometimes. I feel very, very fortunate because we don't really spend a lot of marketing dollar, and most of our businesses really come from referrals and also sharing education. We're really big on, as you can see from my slides, is very data focused, and we do a lot of analysis. So I really appreciate everybody's support and continue to refer us to your clients. And we just hope that we can continue to grow and serve even more clients. So just want to make that announcement. And now I'm going to go right in to talk about the residential housing market updates. Today, I'm going to have residential housing market updates, multifamily, and a short one for the commercial sectors as well. So let's start with the residential market. If we combine the 5 counties, as always, Alameda, Contra Costa, San Francisco, San Mateo, and Santa Clara County, as you see that the number of active listings right now, in January, we saw it was a huge drop, right? And we were thinking that it's going to come up. It did come up, but it really did not come up that much. It's still relatively low. We are still very much kind of similar to what we had in December and January. January of this year. It did come up a little bit, but if you look at the number of sales, that's what makes a difference. I'm sure a lot of, if you're actively looking on the market right now, you notice that there are a lot of competition. So as you see that over here, the red line, it shows the number of sales. Even though the number of active listings, it kind of went up a little bit, but number of sales has shot up quite a bit. Last year, end of last year, it was really, really quiet and slow, but we definitely have seen such a huge uptick in activity. And we've been kind of sharing this news with you for the last 2 months, since I believe at end of January or February for sure, we have talked about the market has picked up. And it's kind of funny in the sense that when we read the news at the time, we continue to read the news as like, oh, the market is really slow, the price was going down. And we kept saying like, well, the news is usually at least 1 month to about 2 months delay compared to the actual what the market is doing. And I think yesterday, that was the first time I actually finally see on the news that they're talking about the market has picked up, but it actually has been picking up starting about the 3rd or 4th week of January. All right, and in terms of the months of inventory, again, as you see, because the activities has gone up so much, we went from 2.5 months in January to 2 months starting to come down, and it just dropped down to 1.3. We went back to almost last year, May, months of inventory. 1.3 is really fast. We really started to see offer deadline coming back, and then people have to make decision 2 or 3 days right after the first open house. So definitely the movement is a lot faster right now. And in terms of like median days to sell, again, we see a huge drop from 28 days when halved in February for 14 days, and now it came down to 12 days. And as for the sales price to list price ratio, it also, of course, you see that it went from like right under asking price to starting to go up, and then went up to 3% over asking price right now. Fortunately, we're not back to where we were back then. Last year, in the beginning of last year, it was over 14%, 14% over the asking price, but still we definitely see a lot more buyers coming in, and they do have to offer above asking price in order to win the property. But this is what interesting is like when I see this number of listings withdrawn and canceled, we actually see more number of listings with being withdrawn or canceled in March of 2023 compared to February. So our numbers came up a little bit, and well, if I think back, it actually kind of makes sense because in January that's when a lot of listings just started to come back onto the market, and then in March that's when like if it's not really selling, then they might pull off the market. But we're talking about just about 100 to no more than 200 per county. So it's really not that many in terms of like how many listings being withdrawn compared to last year. As you see, around June or July, you see several hundreds listings being pulled from the market. And in terms of list price decrease, the Santa Clara County we also see more listings have like a list price decrease, and in San Mateo County went from 83 listings to 120 listings. Alameda County went from 194 listings to 211 listings. San Francisco County went from 134 listings to 208 listings, and Contra Costa County went from 224 listings to 259 listings. So you see that they were definitely peaked around last year, mid last year, and then we have come back down. But then like this month, we started to see a little bit more of like more listings that drop prices. And in terms of transaction fell through, it's also really interesting because even though we see more sales, we also see more transactions fell through. We have gone from 87 listings to 129 listings in the aggregate of 5 counties. So we definitely see a little bit more transactions fell through. One of the reason I can think of is because the mortgage rate actually had gone up slightly, and I'm going to go over that slide with you in a little bit. All right, so let's talk about the battleground. What's going on with all those offers that we've been making? And I have to tell you, it's pretty brutal out there. And surprisingly, when the house is in great location and it has potential, even for a while we talked about, oh, if the property is still if the property needs some updating, around end of last year, you just don't see a lot of activities. The property pretty much have to be in pristine condition and also like in really good location. But now is that if you're in good location, even though the property needs some work, we're still seeing quite a few multiple offers now. So as example, you see that in Palo Alto, a single family home asking price was 1.998, received 11 offers and went up to 2.363. In Sunnyvale, single family 2.88. They only received 2 offers, but it did go slightly above asking price. And even Santa Clara has been. Last year, we would see properties selling at $1.3 million, but now we don't see that anymore. And even a home that needs updating or a home that is like on probate sale, and you see that they received so many offers and still went above several $100,000 above asking price. And then even Milpitas, they did receive 9 offers, and it just went slightly over asking price to $1.01 million. And then we have other areas, for example, and on the East Bay, condo and townhomes, even condo and townhomes right now, they are receiving quite a few offers, and also they are going above quite a bit of money above the asking price. So, and Peninsula, of course, in San Mateo, same thing. This is a probate sale, 1.3448, and they received 14 offers and went to $1.655 million. So you see that even in the Peninsula area, there's also a lot of activities right now. All right, so what happens to the median sales price with all these activities? So let's take a look at the activities. Let's look at the median sales price. So we highlighted the last year, right? April 2022 and May 2022, depends on the counties. Those are the prices that have peaked, and we are almost a full year now. But what you see that for Santa Clara County, Santa Clara County, Alameda County, San Francisco County, and Contra Costa County, they pretty much have their sales price higher this month compared to February. So as you see, the Santa Clara County, it peaked in April 2022 at $1.95 million. It went all the way down to about 1.465 and kind of went above, like a little bit higher, a little bit lower, but now this month in March 2023, it shot up to 1.67. And for San Mateo County in April 2022, it peaked at $2.25 million. And it started to come down throughout the months and went down to 1.48. And last month, if you were with us during our episode, we talked about like this is a really weird number. I didn't expect this to stay at 1.95. That was just like a really high number. Typically it happens because there was just this one property that just shot up. So well, sure enough, like this month we do see that this looks a lot more it looks a lot more it makes sense that at $1.7845 million, even though it's lower than February, but I think this trend actually makes a lot more sense. And Alameda County peaked in May at $1.5 million, and it went all the way down to 1.022 in January of 2023, but it has gone back up to 1.205 in March of 2023. And San Francisco at 2.05 in April 2022, and it went all the way down to 1.385 in January, and now came back up to $1.695 million. And then as for Contra Costa County, it went from $980,000 peaked in May of 2022. It came all the way down to $725,000 in January 2023, and eventually it came back up to $820,000 in March of 2023. So if you look at the percentage-wise, Santa Clara County, Alameda County, San Francisco County, they all went more than 10% over what it was last month. And even Contra Costa County is almost 10% from last month. And if you look at year over year, though, from last year, they all came down about 12 to 15% from last year. And if you compare from the peak, the highest price point, then they have come down like from 14 to about 20% from the peak. And if you do remember, we talked about, I think around January, we talked about how much it has come down, 1.95 to 1.465. So let's say if has come down from 1.475, that means it dropped 24%, right? The price. But you know what? It takes a lot more to go back up to 1.95. If we want to, we want the price to go from 1.475 to go back up to 1.95. It actually takes 32% in order to go back up there. So I just thought like to share this with everybody to see that how this is going to take a little bit longer to go back up compared to how fast it came down. But then it's also good to know that this is where the market cycle, you are catching the bottom right now, and we are starting to go back up. And that's why I think a lot of buyers realize that the pricing are starting to come up, and then also and that's why they are all coming back out to start looking for properties. And in terms of mortgage rates, of course, mortgage rate was also one of the factors that affect a lot of the demand. So if we look at the projections, again, Freddie Mac, they no longer provide the projections, so it stopped in October 22, but I still kept their numbers here because they did have the projections all the way to 4Q 2023. I just kind of want to see that how far off of how accurate they are. But if you see Fannie Mae, they did change their projections from February 2023 to March 2023. So within a month, I was very surprised that they had increased for 2Q 2023, they increased 60 basis points, which means that last month they were expecting 2Q 2023, the mortgage rate is going to be at 6%, but now they, a month later, they had adjusted their projections and projecting that the mortgage rate is going to be at 6.6% for 30 years conforming loan limit. And 3Q 2023 is going to stay about the same, and the 4Q 2023 is going to come down a little bit, but regardless, they have increased the projections compared to their last month's projections. And as for Mortgage Bankers Association, they also have increased the projections compared to what they had back in December 2022, but they are also at about above 6% interest rate for 2Q 2023, and then but at 3Q and 4Q they have started to come down below 6%. And for National Association of Realtors, their projections is at 2Q 2023 is at 6.3%, and also they're projecting it's going to go down below 6% for 3Q 2023 and 4Q 2023. And all three agencies, they also predicted that 2024 1Q, the mortgage rates are going to the mortgage rate is going to continue to come down. And this is really exciting to see that it's like really close to 5.1, 5.4%. And as I mentioned before, conforming loan limits typically have a higher interest rate compared to jumbo loan limit. So that means jumbo loan is going to have an even lower mortgage rate. So I'm really happy to see this because I think home buyers definitely need to have some relief as long as we don't have any other factors that might affect the interest rate. Hopefully, we can continue to move to the right direction. And but in the meantime, we want to share with you what's going on with the mortgage rate currently. Last month, the 30 years jumbo loan, again, this is a jumbo loan, that's why it's lower than what I showed you just now. The 30-year mortgage rate is at 5.5%. And as of today, the 30-year jumbo loan is at 5.75. Unfortunately, it has gone up 0.25 from last month. All right, that's it for the residential housing market. Let's move on to the multifamily housing market updates. And here is a chart from Yardi Matrix. And again, Yardi is a property management software that a lot of property management companies use. And so they gather basically data from all over the country and come up with this report. So as you see that from all asset classes and multifamily, meaning there could be different types, different as class A, class B, class C type of multifamily properties. And if you just look at the rent growth, San Jose is actually close to 5% increase, and they're doing pretty well compared to Los Angeles, Inland Empire, San Francisco, Orange County, and Sacramento. So San Jose actually is doing better than the other major cities in California. And as for this one, we're looking at the year-over-year renewal rent growth. So after the tenant has lived there for a year, are they going to renew their rent? And as you see that Los Angeles, they actually have 8.9% of rent growth for renewal, and they're 44.6% of the monthly lease renewal rate. And for and the second place is San Jose, and I'm only looking at California cities, by the way, but obviously you can see that there are other cities in the other country as well. And then San Jose is at 8.8% and with 49.5% monthly lease renewal rate. And Orange County is at 7.9% rent growth and also a 61.2% renewal rate. And Sacramento is at 6.9% with 57% renewal rate. And San Francisco at 4.2% and 50.3% renewal rate. So I think this is a really good number. I noticed that I missed this one, Inland Empire, which is in Southern California. They are number one in our state, California. They're at 10.3% renewal rent growth, and they're at 54.5 renewal rate. So they are actually beating out all the other cities. All right, so here is another report by PwC and also Urban Land Institute. It's from the report called Emerging Trends in Real Estate. And here is their investment prospect trends. Kind of want to see like which apartment asset type that is like the best investment prospect. So first one that they consider really good is moderate workforce type of apartments. I would say that that's more like Class B type of apartments, meaning that they're not as high end as Class A, but they're not as bad as Class C. You have some very solid workforce people that are living in those type of apartments. So according to their report, they are the best prospect right now. And number two is single family rental. Single family rental is actually really, really doing really good right now. And it's a lot of our clients who own single family properties who want to rent it out, they pretty much don't really have any issues renting them out. And number three, we have senior housing and high income apartments. So senior housing, obviously we have like a generation of seniors that basically the demand has been really high, and it's an asset type that's been really, really popular for the past few years. And they're number three right now. Even though they're number three, they are still considered a good investment, and as well as high income apartments. And then number four is the lower income apartments. Lower income apartments, they did get hit pretty hard during COVID, and then it's been a long road. They're still recovering from that. Although they're number four, we are talking about they are still in between fair and good investment prospect. And number five, lastly, is the student housing. Student housing compared to the other asset type, they are not as good of an investment, but at least they are still above average. All right, so what are the recommendation? The buy, hold, or sell according to this report? So according to this report, moderate income apartments, 52.7% would recommend to buy right now. And actually, they recommend the least is the student housing and also senior housing. And most of them, they're recommending that you should just hold. If you do have senior housing and student housing right now, you should just hold. And then, but then it would also be a good time to consider selling these properties right now, the high income senior housing and student housing. They believe that it is better for you to just hold on to the lower income apartments as well, and as well as the high income apartments and senior housing and student housing. As for the opinion of current apartment pricing, are they overpriced, fairly priced, and underpriced? Most people think that the senior housing, they are fairly priced, as well as student housing, they are fairly priced. And they believe that most of these high income and student housing, they are underpriced, while the moderate income apartment and also single family rental, they are overpriced. So this is I think it's just kind of nice to see on the chart to kind of compare, but because moderate income apartments, meaning class B apartment and single family, they're just such popular asset types, and that's why they tend to sell at a much better price as well. All right, and then for National Multifamily Housing Council, they also came up with a report, and we have talked about this before. We all know that for a fact, this country, we just have this very low housing supply right now. But by how much? And we have heard many different numbers. The country, for this report, it says the country needs to build 4.3 million more apartments by 2035. So we are 2023 right now. That means it's about in 13 years, we need to build 4.3 million more apartments. Now, 600,000 units are needed currently at a variety of price points. And of the remaining 3.7 million, more than 1.5 million new units are needed in Texas, Florida, and California alone. Just 1.5 million out of the 4.3 million units they're needed in Texas, Florida, and California. So it really shows that how much California, especially a big chunk of those, they belong to California, and be really short on housing supply. And that is the biggest question, is how do we increase the housing supply? And I think this is something that's really important for policymakers to think about. I always say that policymakers, they need to have some business sense as well, to instead of just putting Band-Aid on a wound, they need to really dig deep and figure out how to fix this, instead of just like slap on some kind of regulations to fix whatever they see in front of them for now. And I'll share a little bit what happened in the city of San Jose. We have some really good news yesterday, but for now, let's look at the multifamily loan rate. And you see that multifamily loan rate, we have a little bit much bigger range on the interest rate. It goes from 4.95 to about as high as 8.3% on the mortgage rate. And you see that the terms, they go from 5 to 25 years. So for multifamily loans, it's different from residential loans. A lot of times they amortize over 25 years, and sometimes you can amortize over 30 or 35 years. But then their fixed rate portion, it goes from, could be 1 year, 3 year, 5 years, 7 years. And typically we see that the most would be maybe like Freddie Mac loan at 10 years fixed rate, but after that will be floating. And so that's when people, multifamily owners, they need to refinance. So that is actually really something that need worth thinking about, because as I mentioned in the previous episodes before, as much as we see the residential market is doing pretty good, it's pretty healthy, but the multifamily market, that's where we see that because most of the loans, they have a short-term fixed rate. So for those people who have gotten their loan for 3.25% or 3.5%, and now if they need to refinance with higher cap rate and also high interest rate, their monthly payment could double, or even they have to pay down the loan in order to qualify. So that can cause quite a bit of default that might happen soon. So this is a report I pulled from a CoStar to look at East Bay multifamily market. If you look at the East Bay multifamily market, the vacancy rate, where currently we are at about 7.7% vacancy rate, they are expecting the vacancy rate to continue to go up. And also the annual rent growth actually is going to come down slightly for 1.2% to 1.5%. It's going to continue to go down until about 2024 4Q. That's when you start seeing the rent to start growing. And market sales price per unit is still ranging about $400,000 per unit, but it definitely from this point on, it looks like they're predicting the market sales price is going to start to come down. And in terms of the sales volume, you see that the sales volume had shrunk quite a bit. So this is something that we should definitely a lot of our multifamily investors who are interested in buying, they would realize that, gosh, I just don't really see a lot of inventory. And interestingly, despite our interest rates at over 6%, the cap rate is still lingering around 4%. And San Francisco, the vacancy rate is right around 7.4% right now for 2Q 2023. They're also expecting it to go up, continue to go up to about 8.5% to 2025. And then also the rent is going to continue to go down, especially after this quarter. And then the market sales price on average is about $660,000 per unit, and it's starting to come down to about $630,000 per unit. And the sales volume, same thing. Actually, the sales volume didn't shrink as much. It actually stays pretty relatively healthy right now. And the cap rate is at 3.5% cap rate. Again, I know a lot of people ask me, like, how is this possible? And this is one of the reasons why we have such a big gap between the seller's expectation and buyer's expectation. Buyers are thinking the mortgage rate is over 6% right now, 6.5% right now. How can we buy it at 3.5% cap? But then at the same time, the sellers are still expecting to sell at this price. So therefore, we still see a lot of buyers though have cash, and that's how they are able to manage to purchase these property despite such a big gap between the mortgage rate and the cap rate. As for San Jose market, the vacancy rate, we are doing pretty well at 5.4% compared to East Bay and also San Francisco, and it's gonna top out at about 6.5%. And then the rent also gonna come down slightly, less than 1% for the next 2 quarters, but it's gonna continue to grow, although very little, but it's still, at least it's positive. And for the market sales price for the apartment units, it's going to linger around $600,000, and it's going to come down to about $566,000. And then also the market cap rate is right around 3.5 to 3.7% market cap rate. And we see that the absorption unit would have come down quite a bit. If you look at Q4 2021, 8,715 units, came all the way down to 1,544 units. So as you see that there are definitely a gap between the buyers and the sellers' expectation right now. And here's just a quick summary on Stockton, Modesto, and also Sacramento, where you see that market rent came down for Stockton, but Modesto actually have come up, and while the market rent for Sacramento has come down as well. And so these are the rent growth actually right now for Modesto is doing pretty well. And now for University of Denver and also Vancouver Institute, they have these reports regarding the forecast on the apartment market for 2Q 2023. And we always want to look at cycles, right? Where should you invest and when you should invest? So by knowing and understanding where our market is, and by the way, I always say no matter what market you are, there's always a different cycle. So even though we can say like today is a seller's market, but another city may not be a seller's market. So this is what we need to really look at, is that based on the city, where are we right now in that market? So you see that San Jose and San Francisco, we're kind of at the peak right now. We were in expansion, but we're right around the peak. So it might start to come down like we had mentioned earlier on the chart. So this is something also another reason why you see that a lot of apartment investors, they're just holding out, waiting right now for the markets to start coming down before they invest in the apartment buildings, and especially in the Bay Area. And this is what I want to share with you guys earlier about the policy making. So yesterday, City of San Jose, they had their council meetings, and it has been a big debate, a debate regarding the COPA, Community Opportunity to Purchase Act. There are hundreds of people, and I think it went for about 5 hours meeting, and hundreds of people gave their feedback, their opinion, and of course, one group really against it and one group really wanting to vote for it. And then at the end, they did vote. Nine council members had voted against the COPA. And COPA, this is just in the simplest term, is that if a landlord needs to sell their property, if this passed, that means you have to sell it to the nonprofit first before you can put it on the open market, which is what San Francisco is doing right now. And Santa Clara County Association of Realtors have been very vocal about this. As we represent a lot of landlords, we do see that it could be a very unfair situation for these landlords. And honestly, most of the landlords, they are not greedy. They just want to have a stable tenants. And so many of our clients actually friends with their tenants even. So I don't feel like this COPA Act would actually help with affordable housing issues. At the end of the day, we need affordable housing for sure, but then by doing that, we have to have more housing by increasing the supply. And that's the question: is how do we increase supply? Will we be able to increase supply by implementing more fees on the developers or more red tapes? So that's a lot more to talk about, but I just kind of want to mention this with you all. Oops. All right, and in terms of commercial real estate market, I actually just attended our CCIM certified commercial investment member institute's meeting last week in Boston, and I definitely have received a ton of updates. So I wish I have more time to share with you, but I'm just gonna blow through this real quick so we can talk to Mark more about the insurance policy as well. One of the biggest news right now is that San Jose, as you know, the Google was building this mega campus in San Jose. And right now, CNBC has reported that they are on hold and got a lot of people really freak out. And Spotlight, San Jose Spotlight, they actually had mentioned that Nancy Klein, who is with the San Jose Economic Development Director, and she had said that, well, obviously, this is a 15 to 20 years build out. So there's definitely cycles. The economy is not doing as well. And it's not surprising that Google is pausing right now. But I think that title with CNBC kind of scared a lot of people because they thought like, oh no, it's like the whole mega campus they're not going to do it anymore. I'm not saying I know what's going to happen, but I really think that it's just going to be a pause. They have invested tremendously in this, downtown San Jose. It's just a matter of when the economy is a little bit better, they most likely is going to come back and start the demolition. And of course, we have another bad news is that Meta had announced that they are going to lay off 10,000 people, right, from their company. So this news definitely had shaken the economy and also a lot of people. And it sounds pretty scary because even some of our clients who work for Meta had some concern as well, whether they should continue to look for homes or not. So this is very understanding, but that has caused quite a bit of fear and some of the consumers. And on top of that, if you look at this chart, how fast the Fed has increased the federal fund rates compared to any other time when they increased the rates. They, like some of these, for example, here is 2015. It took 36 months to increase just about 2% on the Fed fund rate. For us, 2022, it increased in just less than a year, over 4% in just 2022. It shows that how this trend can really have quite a bit of impact in the economy. And then now this year, though, 2023, they are going to slow down on the increase, but they're not stopping yet. They had already increased another 25 basis point in March. they're predicting that they're probably going to increase another 25 basis point in May, and but they do believe that the Fed appears to be coming close to an end of its rate hiking cycle. So hopefully we're not going to see too much of an increase, but I know that they are still trying to target an inflation rate at 2%, and we are still quite a ways to go. So but in order for them to slow down the inflation, that's why it has caused quite a bit of um, like panic in the society, including companies laying off people, banks are shutting down, and so these are things that the after effect of the Fed fund rate being raised so quickly. And this is a CREPI CREPI index. It's a new index that is brought in by CCIM economist Casey Conway. And this is a measure of the U.S. economy and commercial real estate property condition. It comprises of 10 forward-looking measures. And so it reflects more decline, what the consumer, small businesses, and housing industry are telling us right now is that, as you see here, we had quite a bit of confidence back in November of 2020, but it has dropped all the way down here in July 2022, although it started to come back up slightly, but we are still really far from where we were in 2020. And office market, if you want to see San Francisco and San Francisco, we're actually kind of starting to recover, but like San Jose, we're actually in recession, and also mainly because San Jose has a lot of office buildings being constructed right now, so they have a ton of supply for sure in downtown San Jose. And as for the industrial market, we're actually still going up. We're at the peak right now in the industrial market, even though we say commercial real estate market is slowing down, but in the industrial market is still really, really hot, surprisingly. Well, I shouldn't say surprisingly, actually, because a lot of people do need warehouse right now. And then in terms of retail markets, San Francisco and San Jose, we also almost at the peak right now. And hotel market, though, on the other hand, we are right here is starting to go back up. We are still not at the peak, but then we are definitely in the expansion stage. All right, so I think I finally went through everything. So I know there's a lot of information, and now let's go to Mark Hicks so that we can start talking about insurance. Hey, Mark.
Hello.
Oh my goodness, that was a lot of information.
Nice, but it was good. It's needed. It's needed.
I hope nobody have fallen asleep yet, but I will let you go ahead and start because I know for sure that a lot of people want to know more about this and what kind of mistakes that they can avoid, and also how can they maximize their insurance coverage.
Most definitely. Most definitely. Well, everybody wake up. So let me take over the screen here.
Oh, if anybody don't know, Mark is from Farmers Insurance, and he's been with Farmers. Oh, maybe you can tell us a little bit about your background.
Yes. I mean, I've been in the insurance industry for 14 going on 15 years. And I mean, it's something that I stumbled upon, 14 years ago, that it was never something that I said, oh, I'm gonna, I woke up and said, hey, I'm gonna be an insurance agent. But I ended up growing to love it, and I'm just a very social person. So for me to be able to talk to people every single day and kind of get to know them and understand where they're coming from, it really does excite me. So
That's awesome. Well,
14
you
plus,
gotta have passion in order to do what you do, really.
definitely, definitely, for sure. And can you guys see my screen?
I can see the presenter screen.
Okay, let me see. This is working. One moment. There we go.
All right. Perfect.
Perfect. So yes, I'm going to talk today about essentially avoiding common mistakes and maximizing coverage. Insurance is it can be very difficult. So having someone that actually can kind of break it down into a simplistic form makes things a bit easier. So let's get into it. Kind of a quick agenda. The intro, going to what we insure in my agency, and you kind of more understand what I mean when I say proactive, not reactive. The location and use of the buildings, common mistakes, of course, and preventative measures. So a little bit about myself. I'm a Bay Area native, born in San Francisco, raised in San Jose. My second home is 100% Chicago. I mean, outside of my sister and I, being born out here, my entire family is in, the south side, west side of Chicago. So Chicago has my heart, especially the food. Uh, Graduated from San Francisco State with a bachelor's of science in business management. Um, Married, as you can see on the left. I'm a goofy person once you get to know me. So all my pictures look like that. And my first daughter is named Marley. Originally, I thought she was very calm and didn't realize that, when she was neutered, she was on medication. And then once she wore off of that, she ended up being a crazy dog. So training, she's better now.
Is it
um,
just like the movie Marley, Marley and Me?
exactly. And my agency is based out of South San Jose, for those that don't know, in Almaden Valley, off Camden Avenue and Almaden Expressway, like right behind the Bank of America on the corner. What we insure, I mean, I'm a farmer's agent, but also connected to other insurance carriers. So I like to call us a one-stop shop because we literally insure everything. And then kind of go into the multi-unit buildings, 5+. Um, we insure what's listed here. I mean, apartments, condominiums, townhomes, multifamily, which are included in that same group. Whether in some cases you have maybe an apartment building that just 5 units and the owners living in one and the other ones are rented out. I mean, that's acceptable as well. PUDs and HOAs as far as the residential side goes. At least with farmers, there's kind of a max on 24 units per fire area. Other carriers have different requirements, and subsidized housing programs could be unique, but they are insurable. Also, marinas, docks, or lakefront properties could be included, within the same category. On the commercial side, the retail, the industrial, the office buildings, those are also, buildings that can be insured, given, you're going through a transaction, either purchasing a property or, of course, looking for, another, get at least maybe another second opinion on your current coverage. Be proactive, not reactive. I'll say that insurance is normally the last item on everyone's priority list, unfortunately, until something unexpected occurs. As my father would say, emergencies are emergencies solely because you didn't plan for it. So, let's prepare ahead of time so when things pop up, it doesn't seem like the world is coming down on you. As you can see, kind of the top right, that's a photo from the Paradise Fire some years back. And then even the flooding on the bottom right, that's for those that are familiar with the Pajaro Valley near, Watsonville, Santa Cruz area, when we had the crazy rains, that entire city ended up flooding because the levee broke. And, sad to say, it was something that the city knew was faulty, but just never fixed it. And, they ended up having, tons of people that their homes were inhabitable, and it was a very sad thing. I mean, they're still repairing it. It's going to be millions of dollars that are going to have to go into rebuilding that place. I mean, it's a huge farm town, so a lot of farmers have lost a lot of crops and properties. So it definitely these issues and these catastrophes have to be considered when looking at insurance and the price points. I mean, so quickly the annual inflation rates have raised close to 8.3% in 2021 to 22. I mean, this completely affects repair, replacement, and the rebuild of properties. Construction costs have gone up by 26% plus or minus. And in 21, I mean, not even counting 2022 and now 23, 116 billion has been paid out to natural disasters. So that gives a lot of good info and insight on just how many things need to be repaired all at once. So what matters? The location and the use of property. And for real estate, I mean, that's really the thing that matters: location, location, location. Um, so on the insurance side, I know on the real estate side, it's more of a kind of market-based approach, looking at their price points. But when it comes to insurance carriers don't necessarily care about what someone else is willing to pay for the property, or they care about how much it actually costs to rebuild that particular building. So location is huge. They base it off of the wildfire score, and that is essentially, you can kind of look at it as you having a driver's license, and the more tickets and accidents you get, the less likely an insurance carrier is going to want to take a risk on protecting you. So it's the same thing with properties. If they know that there's a particular home that's had 4 claims in the last 3 to 5 years, especially if it's related to wildfire, more than likely the price is going to be ridiculously high, or they're just going to say, we don't want to take on the risk. And now you're searching around for carriers. Is the property in the designated flood zone? FEMA is the biggest flood insurance carrier out here. And if the property is in a flood zone, I mean, one, if you're getting a mortgage or doing some type of financing, more than likely they're going to force you to get flood insurance. But the thing is that many people don't get flood insurance unless they're forced to. And since the recent flooding, we've had a lot of incoming calls about, hey, do you offer flood insurance in our area? And it's a yes in most cases. So it's always something to think about. Is a property on a hill or a mountainside? I mean, that matters, right? Because if there's mudslides and a history of mudslides, insurers know that at some point, if the rain is really bad, these mudslides can possibly demolish the home. So again, you may be charged more, or you simply just can't get insurance through a particular carrier. Is the property accessible by dirt road or a public street? That matters because of, if there's a fire, if you live up a hill and it's 3 miles up, that just means it's going to take longer for the fire department to come up and diffuse the flames. So that can affect if the property is insurable or not. Of course, the age of the building. No insurance carrier is going to want to insure a old building. That's just simply put. And kind of into that age of the building, the condition of the building, like is it maintenance properly or not? Also, hazards around the property itself, like trees or power lines. I mean, that affect future claims. The use, is it a long-term or short-term rental? Is it like you have a 12-month lease with someone, or is it just a Airbnb situation? That matters. How many occupants do you have within one building? Is it subsidized or not in any type of subsidized housing programs? Because those are also insured differently compared to just a typical 5-unit apartment building. Does the owner, as I mentioned earlier, does the owner live in the unit and the other units fully rented by individuals? And also, again, is there a signed lease agreement that's updated yearly? I mean, that's key. And insurance carriers pay attention to that. And if they can confirm that you don't really have a lease agreement signed up, I mean, one, it's in your best benefit to have that. But, insurance carriers want to know if you're actually renting the property, you know, to its fullest capacity and actually documenting the rents.
So is this talking about the multifamily? Let's say if you have a 20-unit apartment building, do they require a signed lease agreement that's updated yearly? Because most of the leases, they would say that it automatically go into month to month afterwards, after the first year.
And that's fine as long as it states that. That's
Got
perfectly
And they want
uh,
to see like from for every single unit.
right. Right. Because in some cases there are individuals that rent out properties, and it could be a slumlord situation, and they say they have a lease agreement and it's really not there. And the last time it was signed was 2013. They're trying to confirm that that's not the case.
And people, I have to tell our buyers sometimes, like you'll be so surprised how many sellers out there or apartment owners out there just do not have a formal lease agreement, and or they write up their own agreement or terms on an addendum that it didn't even
Exactly.
make sense. It has so much loophole on it that we couldn't even advise our clients to take over that lease because it's just too vague and it's not written correctly. So yeah, we always recommend our clients, if you are really trying to maintain the value of the property, you should hire property managers to do that, to do your leases.
Yeah, exactly. I mean, because not only, is it an advantage to ensure that you can insure the property properly, but also to ensure that there's no huge liability in the future because you didn't have the correct lease agreement written up. So yeah, very important. Uh, right. So some of the common mistakes. I know you all have been waiting for this. uh, Number one, and this is from really personal experience, um, buying a property before verifying if the location is eligible or ineligible. Um, that's a key one because sometimes, I mean, as we know, especially in real estate, people can get emotional. I mean, especially if you're, buying an investment property and you're like, oh my goodness, these are the numbers. This is my return on investment. Looks great. And before you know it, you buy the property, sign all the paperwork and determine that, oh, we can't even find a company that wants to take on insuring it. So it's always good to check on that before purchasing, and it doesn't take long. I mean, as we know, the purchase process is way longer than just saying, hey, Mr. Insurance agent, can you just check this address to see if it's insurable?
Yeah, especially I mean for residential market, a lot of times like are probably a little bit easier, but then like for commercial properties, it's important to actually get a we used to get the clue report, which is yeah to see that if there was any past claim on this property, because if there was a fire just a year ago or 2 years ago and it looks great now because it's all fixed up, doesn't mean that the insurance company is going to insure it still.
Exactly, exactly. And I'll get to that in a second too. That clue report is key. Okay. Um, number two, not insuring the building to 100% replacement cost value. And for those that don't know about co-insurance penalties, especially when it comes to, we're talking multifamily units, right? If, let's say, for example, you have a multi-unit building and I've calculated that really the coverage amount should be $850,000 to insure this whole entire building, for example. But you choose to insure it for 700,000. And honestly, most of the time, there's usually that kind of back and forth because of price, right? It's just a price point. But the issue is that if you do insure the property below the replacement cost value, what happens is the insurance company is essentially going to say, hey, since you're not being more responsible in insuring the property to the right amount, we're going to impose a penalty if a claim were to happen and it were to be totaled. So not only are you not going to get the full replacement value, but we're also going to penalize you. Some companies, it can be 30%, 40, just for the simple fact that you didn't insure it properly. So it's never a good idea to say pennies because you can end up, forking out hundreds of thousands of dollars, which you don't want. Um, Number three, insuring the property based on price point, not coverage need. That's a huge one because majority of the time as consumers, we're looking at price, but especially with insurance, I mean, real estate, like you do have to kind of flip the thinking and look at it as what do I actually need? Like what coverages do I need for this particular property? What am I trying to do with the property? Like what's the intention? And that should be the kind of the forefront. And then after kind of figuring out what your price point is. And then number four, just not updating, the fuse box or panels, or you have exposed wiring. I mean, those are obviously going to be issues, not only with, you just purchasing a property and have it in your possession, but, insurance carriers notice things like that, and that could be a reason to not insure you. Number five, submitting claims that are more, that are more maintenance related than a catastrophe. What I mean by that is that many people look at insurance like almost like a warranty, as anytime something happens, I just need to submit a claim and have the insurance pay for it. And that's, it's obviously what it's there for, but you don't want to get, claim happy and submit claims back and forth, because what ends up happening is not only do you lose a claim free discount, but also insurance carriers are going to look at that and say, well, this individual has submitted 6 claims in the last 3 years. Their propensity to submit more is high, so we're not going to take on the risk. You need to go somewhere else. So I always try to say that, unless the claim you're submitting is a catastrophe and it's so much higher than your deductible, like say, for example, the roof caves in and your deductible is 10 grand and it ends up costing 50 grand. I mean, I'm just saying on low numbers, right? That would be a reason to get a claim submitted. But if you know that it's barely above your deductible amount or even below, don't submit it, because even if a claim is put through and no money's paid out because you decide, actually didn't end up costing that much, you can still get penalized for just having a claim on your record. So it's always good to have a knowledgeable person kind of let you know that beforehand.
So is it sorry, kind of to ask this question. So is it better to hire an outside adjuster, a claim adjuster before you decide?
So it's better to actually have a like especially if it's a roofing issue, right? Have a roofing company come and look at it and actually assess the damages and prepare an estimate. So then once you get the estimate, you can see, okay, Mark said my deductible is 10 grand. This company said it's going to cost $95,000 to fix this entire roof. And that's when I would say, yeah, okay, it's time to submit a claim.
Yeah.
But if it's lesser than your deductible, or even just a couple grand over, it's actually in your benefit to not submit a claim, because the rates can go up and you're stuck with that for 3 years, and it could be more expensive that way than just paying out of pocket for it, depending on how severe it is. Oops. And lastly, for HOAs, looking at the CCNRs to determine the unit owner's coverage. That's a huge one, very big one. Most of the time, nobody reads that paperwork because it's 80 pages long. So I get it.
200 pages long a lot of times.
Right. So no one reads it. But, there are sections, and there always should be someone available to kind of explain, hey, what type of coverage, do you guys provide from the HOA, given that I'm the unit owner. And most of the time it's some type of like walls in coverage that you have to have, because they'll kind of cover the structure, like the roof and the, exterior. So it matters, because you also don't want to over index on coverage on your policy when it's not needed. And claims follow the building, not just the person. So that's something to keep in mind.
Not just the person. So not that not the person, it's not just the person, it's the person and the building.
Exactly. All right. How to prevent mistakes. So we just have to look at insurance differently. It's really here to protect your investment in the building and the revenue streams that you're looking at gaining from it. Unexpected lawsuits constantly occur in California. So you don't want to end up having your personal assets exposed due to, improper coverage. I mean, because the worst thing that can happen is you say, well, why didn't you talk to me about that coverage? It was, $100 to add on. I mean, that's the worst conversation to have, on both ends. So prepare for it. All right. So likes and dislikes. What insurance carriers like. Um, they like properly maintained buildings. They like claims mitigation tactics like alarm systems, working smoke detectors, fire sprinklers, updated electrical HVAC, plumbing systems, updated roof if the roof is more than 60 years old. If the fire department is within a 5 mile radius, that's good. If the fire hydrant is within 0 to 1,000 feet of the building, that's good because they know that if fire occurred, they have easy access to water, it's close by, and they can mitigate that loss. Proof of insurance coverage from the past 3 or 5 years. If we're able to verify that you've successfully had insurance on the building, that's a green check mark for insurance carriers. Proper railing and handicap access. That's huge. And also the tenant occupancy has to be at least 85% or above. They want to see that, not where you have a building and half of it is livable and the other half is vacant. That's not normally a good scenario.
And this applies as well to retail and all the other commercial properties like office buildings as well.
Right, exactly. Um, what we don't like, you know, the opposite, fire stations more than 5 miles away from the property, not easy accessibility from public roads, unclear usage of the property. It's like, are you doing Airbnb? Are you renting it out for 12 months? Is this a business? Are you having, business owners come in here and rent? What is it? That needs to be clear. Given the wildfires, heavily wooded areas with, dry brush, trees and shrubs, that could be an issue. Swimming pools that aren't enclosed, an old roof, again, lesser percentage of occupancy rates, and vacant buildings for more than 60 days. Most of the time they know that if you're purchasing a property, once it kind of gets to that point of, everything's in, they know really it should only be vacant for so long. So, unless you can, unless there's like some type of extenuating circumstance that is allowing it to stay vacant, that's different. And then also, older buildings with no updates to building code standards, constructed in the last 50 years, that's a red flag if nothing has been updated. It's, they look at it as it's bound to fail. Essentially, same as if you have an old car and put in a new engine, we know it's going to run better. So the same thing with properties. The more updates you have, the better off and, less claims you're going to have in the future.
So, a question regarding like vacant properties. There are some properties maybe not vacant, but then they're vacant right now because they need to do remodeling. So, what would a person need to do if the property is going through a remodeling process, and maybe it could take like 4 to 6 months or even a year?
Good question. If the policy, in most cases, if the policy is already like active and it's not like a new building, then remodeling is, it's normal. But that would kind of be like an extenuating circumstance if it's a new purchase and you're deciding from that date that we want to update it. There are insurance carriers that are specific to covering vacant buildings that are being remodeled. So it just has to be clear on what's actually happening with the property so you have the correct type of policy given that particular scenario. So yeah, that's pretty normal. It just has to be communicated that that's going on.
Got it.
So if you're on the hunt, some tips. Choose an insurance agent the same way you would a real estate agent. One, I always prefer a local agent. Obviously, if you're with a call center that's in Minnesota, they're probably not going to know and understand the same type of, graphs that Helen was just showing. They're just not going to have all that same information at all. They can look it up online, but they're not physically here in the Bay Area. So, having a local agent, you're familiar with the location, cost per square foot, and, eligibility requirements. Two, on site, willing to be an on-site underwriter and visit properties. This was kind of the old way insurance agents confirmed if the property was in a good condition or not. And to this day, I still do it because sometimes people aren't truthful and you do want to physically look at the property to make sure that it's not falling apart. Three, years of experience. Experience in the industry matters, obviously, so you can tackle unforeseen underwriting issues. Four, education. It doesn't have to be just, oh, he went to college. It's just really the level and understanding and about insurance on a micro and macro level. And, pretty much, nerding out and knowing so much that you're just willing to display it to everybody. And lastly, how does your current agent present? Again, are they in a call center or are they in your neighborhood? I mean, presentation matters, and that will either make you feel uncomfortable or comfortable with choosing to go with that particular agent. To summarize, insurance is complicated and tedious. At first glance, it's a headache due to it being a requirement and pricing could be a juggle. It's imperative that you establish a relationship with the tenured professional who you trust. Take the time to review the coverage to maximize your chances of a covered claim in the future. The current insurance market, similar to even real estate, is murky right now. So it's smart to have an insurance broker in your back pocket. Thank you.
Oh, thank you. And I cannot emphasize enough is that a lot of times our clients just kind of look at, okay, I'm just going to pick the quote that is the lowest without really looking into the coverage amount in terms of like what you're saying, the replacements cost. I had an insurance agent before who gave me a quote that was really attractive, but then when I look at it, the coverage doesn't even cover if my building gets burned down. And so it's really important to make sure because it does happen. I mean, even though it's only like 0.1% chance, you just don't want to risk that because if you are in that situation, it can be really devastating.
Right.
And I'm curious about also the liability issues because, again, obviously, a lot of investors who are buying commercial properties, they also have to worry about the liability side because they have tenants in there, they have other people walking into the property. What should they know about those kind of policies?
I mean, every policy is going to have some type of, like residential is going to have, well, I guess homeowners, residential homes are going to have more like personal liability when it comes to like multi-unit buildings. There's going to be that liability, but it's going to be more of a, business liability use since it's more, because you're receiving income from the property. So there's always going to be that coverage there, whether it ranges from 100,000 to, most of the time it might go up to 1 million. But it's about, I look at liability coverage as protecting assets and your net worth, rather than just how much does it cost. So one way is to get, higher liability coverage on that policy. And also there is something called like a commercial umbrella that will go above $1 million. From one, I mean, to, 2, 3, 4, 5, 10, 25 million in some cases. And that will kind of cover above what you're limited at on the actual property policy.
Oh, that's a good segue to answer what is an umbrella policy, if you can elaborate on that.
Yeah. It's essentially just an access liability policy. So whatever, policy you may have on a particular address, let's say you chose 500 grand, you get sued, it goes above 500, you're exposed because you're limited at that amount. And the umbrella pretty much just kicks in over that amount if that type of situation occurs.
So, on top of your own already like your own insurance policy, there's also another umbrella policy to protect any additional, I guess, like additional risk that you might have.
Correct.
And then, how often do you recommend somebody to buy that umbrella policy?
Constantly, to be honest. I mean, if we were in, Idaho somewhere with a population of 1,200 people, I probably wouldn't really talk about umbrellas too much. But in the Bay Area, I mean, it's people make a lot of money and own a lot of properties. So I think that most of the time, I mean, just based off your house, you're already worth $1 million. So having an umbrella is important, whether it's business or personal.
So why wouldn't somebody just increase their coverage on their original policy instead of having an umbrella policy?
Well, I mean, it depends. it that can happen where you just say, okay, I just want $1 million on my property policy and no umbrella. But once you kind of start adding in everything, like okay, you have a 401k, you have the primary house, you have the rental properties. I mean, there's it's all assets. So once you add it up, your net worth is X, and most of the time it's just automatically going to be over $1 million. So that policy is not going to cover up to the net worth. So then you do need that cushion.
Got it, got it. And Jose Monar said that I know we're in California, but what's going on in Florida? Insurance rates are skyrocketing. Is it because of the hurricanes or what? Do you know?
Yeah, I mean it's definitely all of the catastrophes out there. I mean the hurricanes, the flooding. I mean they're paying out billions of dollars to repair many of these places. So I mean you can imagine if you know, let's say on a dollar perspective, you pay in $1 for a policy, but then the insurance carrier is paying out 7. I mean at some point they have to raise the rates because they're literally losing money. Um, Plus it's state regulated, so you can really only increase insurance rates up to so much in a certain amount of time. So yeah, I'm sure all the rates are going up because of all of the claims that have been had in the last 3 to 5 years.
Yeah, and then it's just like before this past winter, the flood insurance probably not as expensive as after this winter time. Before winter, nobody really even bothered to look at flood insurance, and now all of a sudden everyone is looking at flood insurance.
Exactly. Earthquake insurance too. It's the same thing. As soon as that fault line gets hit, hey, do you guys do earthquake insurance? But then at that time, because it hit that particular fault line, if your house is near there, the price is going to be more. So
That's yeah, actually, I have heard from other insurance agents saying that it's not even worth it to get a earthquake insurance because the deductible is extremely high.
yeah, it's very odd. It's very odd. I mean, I only recommend doing it if you really, it's one of those when like if the house is paid off and now it's free and clear, like you're really protecting your investment. I think that's a good time to have it, but everybody's different. I mean, I knew someone that actually got earthquake insurance every other year, so he just like bet it would happen and it wouldn't happen one year. I mean, it was kind of strange. I never saw anyone do it that way, but it's because the deductible is so high and it's so expensive.
That's interesting, and I have to say that in my 18 years of career in real estate, I think I only know a couple of my clients had bought an earthquake insurance policy. Not saying it's right or wrong, but it's just like how interesting that very, very, very few people have earthquake insurance policy, even though we're living in California, just because of the fact that it's just so expensive and deductible is so high. So a lot of times they just feel like I'll just take that risk instead.
That's
Yeah.
true.
Well, thank you so much for all of the information. It's been so wonderful and it was very informative. I really appreciate Mark for what you've shared with us.
Thank you for having me, and I definitely appreciate everyone being here and spending the time out of their day to listen to us. So greatly appreciate it.
Exactly. And I hope that I will see all of you guys next month. And it's going to be another an hour and 15 minutes full of information, a lot of data for us to share with you. So I look forward to seeing you guys next month. Talk to you soon. Bye.